This is Kali Persall, editor of Institutional Investing in Infrastructure, and I'm here today with Dimitrievich, portfolio manager for energy infrastructure credit at Nuveen. So for our February issue of I3, I actually picked up a white paper you wrote that makes the case for non-investment grade energy infrastructure debt. Can you just walk me through some high-level takeaways from that?
Sure, and Callie, great to be with you, and thanks for the invitation. And the white paper that we wrote really ties on a couple of key themes. One, in terms of the addressable market opportunity in energy and power infrastructure, just generally, it's a huge historic opportunity. One, because of all the news you're reading about artificial intelligence and generative data, the power demands associated with that are quite significant. And just to level set, if you think about a chat GPT search, that takes 10 times as much power as your typical Google search engine. And so when you start thinking about 10 times more power for just an individual search and extrapolate to what that means in terms of power demand, capital investment as companies start to really employ AI, it's a huge, huge opportunity. So there's going to need to be a lot of capital to support that. Two, in terms of just the geopolitics that the world is in currently, there's this trend to move away from globalization of trade and to really focus on manufacturing and industrialization back in the domestic markets. And certainly that's a key focus of the Trump administration. When you have this type of investment in manufacturing industrialization, that requires a tremendous amount of capital investment for energy as well. And I'll give you an example. There's a semiconductor chip facility that's being planned for upstate New York. And when it's up and running, it'll require as much power as the states of Vermont and New Hampshire combined. That's just one actual plant. There's approximately 180 facilities that are being built currently or being developed in excess of a capitalization of $1 billion. And so you can just think about all these massive projects and the energy demand that comes with them. It's a huge, huge opportunity from an infrastructure investment standpoint. And then thirdly, the whole notion of electrification, whether it's electric vehicle transport, areas where you really try and use electricity instead of hydrocarbons, that's another huge opportunity. So those three things, AI, manufacturing, and broadly speaking, electrification trends combine to create a huge, huge need for capital in this space. And so you've got a growing historic opportunity in terms of the addressable market. And where infrastructure credit fits in is really a function of how these types of projects are funded, whether you're talking energy projects, power projects. Typically, the debt part of the equation is 60 to 80% of the capital need. And so as we look forward, the amount of credit capital that'll be required to fund these areas of growth is significant. And so Naveen and our strategy is really focused on taking advantage of a growing opportunity and credit being a key part of the solution. And specifically, my strategy focuses on non-investment grade credit. There's a tremendous opportunity there for a host of reasons. One, the nature of some of these investments require more flexible capital, and that typically involves some type of private non-investment grade solution. And two, because of the regulatory environment under Basel III, we're really seeing that banks are not able to really keep pace with the opportunity set I described. And so that just creates a hole where private credit managers such as Nuveen can really come in and provide the solution.
Yeah, thank you so much. I know that a lot of people are interested in that in our space. So I just wanted to pull out a few points to talk more with you about. You cited a stat that global energy transition investment needs to average 4.8 trillion per year between 2024 and 2030 to meet the Paris aligned net zero scenario. How do you think non-investment grade private debt capital can get us where we need to be, especially as you were saying in the paper, banks are pulling back lending and there are regulatory pressures we're facing?
We saw this trend over the last, call it 10 to 15 years in private credit. Going back to the global financial crisis, when the regulatory risk capital regime was changed for leveraged buyouts and financings, banks had to step back, and private credit really filled that void. And that's why you've seen this incredible surge of private credit uh, become mainstream as an asset class. I think we're in the early innings of seeing a similar trajectory for infrastructure non-investment grade credit. And the reasons are, threefold really. One is, as we talked about, the addressable market increasing dramatically. Two, the need for flexible capital solutions. And then three, banks not being able to fill that void or the investment grade project finance market not really being tailored for this type of flexible capital. The other sort of interesting element that makes this very attractive is infrastructure debt is a diversifier way for many private credit managers or private credit allocators who have had exposure to that asset class. They're looking for some type of diversification, and infrastructure credit can provide that diversification. It's less correlated macro risk. You tend to have contractual offtake arrangements that provide cash flow certainty and downside protection. So, in many ways, the infrastructure asset class is more defensive than the sort of corporate credit analog. And so we're seeing a lot of interest from those investors who've really played that cycle over the last 10 to 15 years start to come into this asset class. And lastly, from a credit equity comparison, with where base rates have gone, with where there's inflationary concerns, one of the things that makes non-investment grade infrastructure credit really compelling is you can achieve the returns that was historically within the domain of infrastructure equity managers. You can actually obtain it now through non-investment grade debt, but at the same time have more downside protection, structural covenants to serve as guardrails. And so it's a little bit of a Goldilocks scenario where you can achieve those returns, but with downside protection in a growing addressable market that has less correlated macro risk.
Yeah, that's really interesting. At our events and stuff, we've been seeing and hearing a lot more about this and how some of the benefits to it. So thanks for kind of touching on that. Um, in terms of non-investment grade credit, I understand that it is sometimes associated with higher yields, but also higher risks. What key factors do you think investors should consider when evaluating opportunities like this in the energy infrastructure sector?
Callie, it's a great question, and we often are asked that because um, there it is high it is certainly higher risk and higher return than the classic investment grade uh, credit instrument. And obviously we touched on that as well. To qualify for investment grade debt investment, the project has to have a certain scale. It has to be well established with typically full contractual offtake. And so that is a very sort of well-designed structure. When you come into non-investment grade infrastructure debt, it is a more bespoke solution. And I think from an underwriting perspective, there are several things that underpin how we underwrite the risk, and they're incredibly important. One, you do have the benefits of hard collateral in the project. You have to make sure that you have the right legal structure and enforcement rights to protect your underlying asset. You need to have certainly some type of hedged or contracted offtake to provide you with cash flow visibility, but you also may be taking some project execution risk. You may be investing through some type of structural complexity that necessitates our type of capital. There are certainly things that we are hyper focused on when we underwrite risk. One is binary risk outcomes. So regulatory issues are something we're very cognizant of, and we've had a change in administration with a view in terms of the regulatory landscape. You have to be able to make sure that that's been mitigated. Two, there's always technology risk issues, and so you want to avoid for our type of investment technology risk if the project hasn't been commercialized. There's always complications, incremental costs, delays that go with that. You've got to avoid that in this asset class. There is a concern around inflation, both from a regulatory standpoint, with potentially in the US and elsewhere imposing incremental tariffs, but you also have labor shortages for some of the product experts that are needed, whether they're electricians, welders, a lot of the core equipment. There's still supply chain delays. You need to be able to have sufficient visibility and cost contingencies and time contingencies when you're looking at these projects to address all that. And so as we underwrite, we think about all those factors. We make sure that we have the right management teams, the right equity ownership of the project to navigate through those types of factors to make sure that the project is successful. So, at the end of the day, what we think about is a combination of all those considerations, making sure we've got the right offtake contracts, and ultimately the right teams to manage the project. And that's why you can't be a tourist in this space. We've Nuveen have brought in a team, that's worked with me for, in some cases, 2 decades, where many of them have operating industry expertise themselves. They've worked, with boots on the ground in plants at projects. So we bring that industry expertise and then really combine that with our credit underwriting skills.